Portfolio Builder members, welcome to our Tuesday webinar class. I'll throw a quick shout out to some of the regulars that I see pouring into our webinar. We got David, Dean, Gary, Jerry, John, Julio, Mark, Mike, Thomas, and quite a few folks I haven't seen yet before. So welcome. I will unmute the mics later. In the meantime, if you do have questions during the presentation, you can use your question box to message me any questions you have. The plan for today is to start off with a review of our most recent trade alerts in our different portfolios. Then we'll go over a little tutorial on how to protect and profit against a stock market crash. And after that, we'll open up the mic and let everybody chat together. Okay, so to start off, we will take a look at our basic portfolio. This product is ideal for investors with at least $30,000 of capital. The strategy is simple. We buy 100 shares of the SPY. By owning 100 shares of the SPY, that gives us the right to sell option contracts. And in our particular strategy, we like to sell call options. This is a lot like owning an apartment in a big New York building, and you're using the Airbnb app to rent out your apartment for income. And so the SPY ETF is not only the largest fund in the world, 2 times that of Ray Dalio's with $240 billion sitting in it. It's also the most liquid security in the world. It trades over $16 billion a day on average. To make things even better for the SPY, it's the only security in the world with options that expire 3 times a week, Monday, Wednesday, Friday. That means we can sell gamblers the option to borrow our 100 shares of the SPY and pull in anywhere from $50 to $125 3 times a week. And if you do the math, if you can pull in $100 3 times a week, 52 weeks a year, that's $15,000 of income. Now, we're not trying to get anywhere near that, although we have been pulling around $90 to $125 per contract during this market volatility. So while everyone else has been losing big, we've been making more than normal. So we'll talk about why that works that way in a minute. The portfolio software that we do include with basic membership is optional. Not everybody likes to use a spreadsheet. This product's very simple. All you really got to keep track of is how many multiples of 100 shares of the SPY do you own? Because then on Monday, Wednesday, and Friday, you can follow our covered call trade alert to generate income and protect your capital at the same time. Current trade alert we are in was issued on 5/13 and it expires tomorrow. It's sitting on a maximum gain of around $1.25 if we are assigned. If we're not assigned, we'll cover it for a profit Wednesday. On the other side of the coin, we're protected to the 277 level. So unless the SPY drops $7.39, we're in a position where we cannot lose money. And so that's what this product is all about. Instead of being a stock speculator yourself and hoping your stocks will go up in value with a buy and hold or swing trading strategy, we're doing the opposite. We're turning your portfolio into a casino and letting the gamblers come in and take their luck. So the big bet that we like to take is that the SPY is not going to jump up $3-5 in a 48-hour period. And that way we can just take the cash from the gambler 3 times a week while holding on to the asset. In some situations, however, when there's a clear market danger, we'll do the opposite. We'll sell a in-the-money covered call, which is what you're looking at today. And when volatility is high, this sets us up in a position where it's very, very hard for us to lose. We may make a little less if the SPY does jump up high, but we're protected significantly to the downside. So that was what this trade alert was all about. We'll review actually the last week's worth of trade alerts issued to the basic program in a minute, just so we can see how this has played out. And again, you don't need to use a spreadsheet, but you do get a copy of this when you do upgrade to the basic membership. So for those of you who do like to keep track of what you're doing in this much detail, this is a very useful tool for that. It's very easy to follow. We put our stock trades right here, and we manage our short positions in the option market right here. And that just means we're selling the option contracts, writing them. Now, rarely we will put on a long position. Currently, we are recommending a long position on a put option on the SPY at the 264 level, expiring July 19th. So for every 100 shares of the SPY, currently during this trade war, we are recommending holding one put option contract on the SPY. So this represents approximately 1% of your total holdings. So not only are we going to have protection day to day with our covered call, we also have the leveraged out of the money put option on the SPY. Now, if we do breach this 264 level, this option contract, which was trading around 369 when we first put it on, would quickly trade up towards $12 to $15. So on the downside, if the market were to fly high from here, this could lose up to 1% of our total portfolio, which is highly unlikely right now until this trade dispute is resolved. But on the upside, this thing could quickly multiply to a return of 300 to 500%, which would just add about 3 to 5% total return to the portfolio. Now, this was launched during the Christmas massacre, so it's been having to deal with both types of volatility in the market. If we pull up the SPY chart really fast, we launched right here on the 12th, right before one of the most horrific falls. And the covered call did a good job protecting against that. We did have some drawdown during that period, certainly. And we also missed out on a lot of gains as the market rebounded much faster than anyone expected. So the result of using the covered call is that we can reduce the pain in the market and still generate a consistent return. So that's the name of the game in our basic program. Now, if you are on a free trial right now, you'll get to follow these trades in complete detail for free until your free trial ends. Now, if you do upgrade to a basic program, we give you 30 days access free to our more advanced programs, which I'll overview now before we jump into the last set of trade alerts we've issued for about a week now. This is our diamond portfolio, and what it does is it looks at what the SPY ETF actually purchases for you. So what are all the funds flowing into the SPY ETF actually purchase? Well, when you look at the SPY and the QQQ, the two highest traded American based ETFs in the world, the funds flow straight into these companies in these proportions. So you end up primarily owning Microsoft, Apple, Facebook, Intel, Cisco, Comcast, Bank of America, Wells Fargo. Now, of course, we pulled out Google, Amazon, and Berkshire because those shares cost quite a bit. You'd have to have over 100,000, and in some cases with Amazon, almost $200,000 just to buy a lot of 100 shares of those stocks. So we did pull those out of the diamond product. This portfolio in this exact allocation per company, which you can see right here, and also in this column right here, costs approximately $150,000 to build. It has a few advantages, and these are the advantages. Number one, because you're buying the security direct and not being, what I might call lazy by purchasing the SPY ETF, your portfolio has a higher degree of risk. Each of these securities has a greater volatility in the past compared to the SPY. In fact, there's almost nothing that has as little volatility in the security world compared to the SPY ETF. Probably the only thing close to it is actually Microsoft, which has just been going almost straight up for decades. And so it actually has a very similar covered call return compared to the SPY. It's the largest position in the SPY and arguably the most important security in the world. But if we do look at the other securities held, we can get a much higher yield from our covered call by owning these companies direct. And another advantage in this product is that now we can aim our strike price at different levels based on where Wall Street is putting their money. So if we see a ton of money loading up on an out of the money call option on something like Cisco or Facebook, which we have recently, we know to write the covered call out of the money and let our asset appreciate and not be so greedy on the covered call contract. But when we see the risks starting to rise, which we did recently, we can start writing the in the money covered call to generate profits from a downturn. And so that's actually what we've been doing, not just for the last 2 weeks, but for almost this entire rally. I've been very skeptical, and this portfolio has performed at twice the return as our basic program. So while having a lot of safety net in our covered calls week after week, this program has outperformed our basic program 2 to 1. So we'll take a look at the current trade alerts on this one. And also look at the previous trades. So today's group of trade alerts, this program only trades on Tuesday as well, so it is a bit more passive and takes on less time. So if you like to trade less and get twice the return, and you have at least 150K capital, then this portfolio makes a lot of sense. And I do want to mention that this does not even consider the dividends that are held in both of these portfolios. This is simply from the covered call income and the appreciation of the underlying asset. And then finally, you'll also get a trial to our whale club. This does have the Google and Amazon positions and has gotten rid of some of the smaller positions. But this would only rotate into that portfolio of tech stocks in the event that the stock market has had a serious correction, at least 30%, and the volatility has died back down. In the meanwhile, this one has been trading the TLT, which is long treasuries with the covered call on Thursdays. So this one's even more boring than all the others, has even less volatility, and is really ideal for $1 million plus portfolios. In this strategy, we're going for less return and less drawdown, and has done that very well, simply following the money. It's looking where the most open interest is sitting on the TLT and trading usually right below that with its covered call. So very simple strategy, very easy to follow, very predictable, and also very easy to learn how the strategy works so that you can really predict the trades before they even come out. Okay, now what I'd like to do right now is take a look at some of our recent trade alerts. And let's go all the way back to 5/7. This was our Diamond Trade Alert Club membership, which is trading this basket of stocks. And so you can see we were getting defensive way back then before the market volatility had hit. And we'd actually been getting defensive most of the year. So while being wrong most of the year, this portfolio has racked up gains. And you can see it's a simple strategy. We start off by buying 300 shares of Microsoft, 100 of Apple, Facebook, Intel, Cisco, 200 of Comcast, 900 of Bank of America, 500 of Wells Fargo. But you don't want to do that without following the rest of the instructions. If you just buy those stocks, you're just another little fish in the ocean getting tossed around by the sea. But if you defend your positions with a covered call, you're playing it more like Wall Street. You're putting yourself in a position to generate a smaller return with very little risk to lose money. And that's what this product's all about. Instead of being a stock speculator, how can we turn your portfolio into more of an investment bank? Instead of lending out dollars, you're lending out shares to people who can't afford them and want to speculate how fast they're going to rise in value. And so you can see exactly how we played last week's. This is the cover. So we were covering the previous week's trades, and we went very defensive. So the week prior to that, we had covered calls that were primarily below the trading price. especially on Apple, and near the money on Facebook, Intel, and Cisco, out of the money on Cisco actually, and out of the money on Comcast. And we actually were willing to take a little risk on Bank of America and Wells Fargo the week prior. And that's because there's a huge amount of call option data flowing into Bank of America and Wells Fargo. And sure enough, they did rally very strong. Unfortunately for us, we played it safe on those. And while we did generate a nice return, we could have had a bigger profit if we hadn't been as defensive on the Bank of America. But you can see we wrote these covered calls with a strike price that was way below the current trading price, which gave us $10 of protection on Microsoft. We had $24 of protection on Apple. And we actually got as low as 185 on Apple, or actually I think 183, so that got very close. Facebook got very close to that as well with $13 protection. We had 10 on Intel, and so these are all trades where if we're wrong and the market goes up, we make more from the credit than we did having to sell our underlying assets. So we're in a situation where if the market went higher, we would do very well, but if the market went lower, we were very protected. And so that worked out very well week over week for us. So that's the diamond product. Again, it has to be somewhat more precautious because it is only trading on Tuesdays. So whenever there's any doubt, this one will write in the money covered call and play it safe. Now this portfolio currently does not have a long put option like our basic program does, and that's because it's still playing these strikes very safely. And I think our timing to enter into a hedge on this portfolio will probably be in a few weeks leading up to this highly anticipated meeting between China and America. Okay, now let's move to the next trade alert. This was on 5:08. Trade talks begin today, play it safe. And again, this is last Wednesday. We had purchased a hedge on TECS and FAS, which is an inverse banking and tech stock. And we're able to sell that for a good profit later in the week. And you can see this is how we're looking at the option market the day of to get a good idea of where there is support. So when we look at the open interest on the put option market, we can see where there's a huge amount of buying of the SPY if we were to reach those levels. So this helps us anticipate where to write our covered call every Monday, Wednesday, Friday. Here's what a sample trade alert looked like on 5/10. Which was again on Friday. And so you can see we were able to collect a $93 profit per contract. And this is just detailing how that profit was realized. This is included in each trade alert. And you can see that the SPY had traded down by 32 cents, but the value of the covered call during this period had increased by $1.25, and that's a profit of $93 a contract. Now, we're not trying to get that profit every period, but as volatility goes up, the cost to buy options goes up. So it makes our business of lending shares to stock speculators much more profitable. And so it's a very repetitive trade. Buy to close is your first step, sell to open is your second step. And you can see we've jumped from the May 10th to the May 13th strike. And in this trade, we actually did get rid of the techs for a profit, the techs and the FAS, and switched to a more leveraged position. So for every 100 shares of the SPY, we then issued to buy this July 19th 264 put option. And so you can see the trades are very repetitive. We give you the screenshot of how to do it and a screenshot of where Wall Street's putting their money. Okay, here is yesterday's trade alert. And again, we made a similar return as we did from Wednesday through Friday, from Friday to Monday. And I actually showed you the compounding. So while the people buying our call options are interested in trying to make around a 50 to 200% return in a 48-hour period, we're trying to consistently make around 0.10 to 0.29% return and try to do that 3 times a week, 52 weeks a year. So that adds up to 156 events where we can put all of our capital to work, have protection, and generate a very high probability trade. And so most of our trades have the odds on our side upwards of 75%, sometimes as high as 95%, depending on how low we go in writing our strike. Now, the more protection, the smaller this return. So these returns pulling in 0.29 typically have a 70% probability. And again, we don't try to do this all the time. Right now, volatility is high. It makes our job much easier. So we're able to sell a covered call that's in the money. That gives us a lot of downside protection. And if we're wrong, the market goes higher, we have a guaranteed profit because the credit we took is greater than the strike we've agreed to sell our stock for. And so during a pretty rough week for most people, our portfolio has just slowly been generating profits. This is based on a $500,000 portfolio. And you can see from Friday through Monday, we were able to generate a $1,274 profit. And it's just a boring, repetitive strategy. That's what this is all about. And this leads us to today's trade. This is the diamond member alert. And didn't have a huge gain week over week on this. If we had covered these yesterday, it would have been larger, but that's okay. We were able to protect the capital. We got a big rebound today. And so the profits on this were just a small return consistently. If we come scroll down, you can see the written instructions for this. The first step is always to cover your positions by buying to close the previous week's covered call. Now you won't get the exact same price, but that's okay. It's all relative to the current trading price. And then we give you the new strikes. So if we look again, you can see these were relatively defensive today. And the bigger the position, the more defensive it was. Now what I'd like to do next is take a look at a few charts. So a few things that are important to keep track of is the dollar index. Rest of the world's really just kind of melting away right now, and money is flooding into America. And so we're not only seeing the US stock market rally very hard, we're also seeing the treasury market do very well and the dollar index. We like to look at the Kospi for a leading indicator of where stock market might be heading. So we did get a little bounce, but in general, there's a lot of risks in the market due to this trade war. The bigger risk to stocks is a long-term reversal in interest rates. So we've had this 30-year bull market in bonds. Is it getting near a bottom and reversing? We're keeping close eye on inflation. Will tariffs help push the target for the Fed in terms of overshooting inflation? And will that eventually cause them to raise rates? And the big fear for our audience is, are we entering a period like the 60s and 70s, the Cold War with Russia? There was moments of everybody getting along, and then moments of escalation, then moments of getting along, and then moments of escalation. It lasted a long time. It created hyperinflation, it created very high rates, and it created a decade of losing money in the stock market. So if you're going into retirement right now, which is our average client, can you risk to have a decade of losses? Probably not. Our strategy makes money even if the market's heading down. In fact, we make more money when the market's going down because call options become far more expensive. And so this is the big risk. How long will this Cold War with China last? And then meanwhile, we keep a close eye on the treasury market. Right now, The US Treasury market has a much better payout than any other government bond that has a strong economy, and but it's not at a rate that's too competitive to compete with the stock market. So if you think about it, if the Fed is aiming for 2% plus interest or inflation, and the 10-year Treasury yield is 2.4, that's basically a break even if they are able to reach their targets. So that's not a big competition for the stock market, and one of the big influencers of our where we put our strikes. Next, I'd like to look at some of the most recent news and things that I'm tracking. Now, in our updates, we've added a link to join our Telegram chats. If you want to get intraday updates from 6 a.m. Mountain Standard till about midnight, that's the hours we're tracking the various markets, the futures markets, the Asian market, to try to keep a close eye of what's going to happen before it happens. And so our product is situated where, as long as we can predict potential risks before they happen, we can simply write a covered call in the money and sleep well at night. So we'll talk about why that's the single most powerful way to protect your assets in times like this. So here's the updates overnight. You can see the Shanghai Chinese index has been getting hammered, down about 10% in the last month. The futures market was showing that it was jumping alongside the S&P 500 futures market, so we knew going into this morning we'd be up today. Meanwhile, China is reacting to the tariffs by devaluing their currency, and the rich Chinese obviously don't want to see the value of their assets depreciate by 10 to 25%. So they are flooding into Bitcoin. Bitcoin is hot right now. So I think there's probably some more room to run in the cryptocurrency space. We'll be covering how to play the cryptocurrency with a tiny part of your portfolio on Thursdays. So look forward to that update on Thursday. Here's the exchange rate of the dollar against the Chinese currency, and it's approaching a very critical level at 7. So it's already devalued considerably in the past month. And that is most likely what's driving the big rush into cryptocurrencies right now. Meanwhile, US bonds continue to be an attractive investment for safety in both the 10-year and the 30-year. And of course, we pay close attention to all the tweets from Trump. Here's just a quick flow through of all of them. Of course, when we saw on Mother's Day, or I guess a week before Mother's Day, the threat to rise tariffs, that's when we first began getting very defensive. And now it looks like this is just going to continue to escalate and turn into quite likely another Cold War. Apple is one of our core positions in the Diamond product, and it has its supply lines based in China. So will they put the tariffs on cell phones? That could be very disruptive to one of America's top corporations. So that's something we're keeping a close eye on. And they're meeting in about 3 weeks. So do we have 3 weeks of relief? We'll be playing it modestly safe. It looks like we already took the big volatility spike, and I am expecting things to be a little more calm until one of these leaders escalates. Bitcoin spiked to 8,000 this morning. If we look at the bond market, we can see there's really no competition. As long as you believe the dollar will continue to be strong and you don't have to hedge against that. For foreign investors, this is the best bond to buy in terms of government bonds. The German yield's negative, the Japanese is flat, and then the Hong Kong is sitting at 1.6. So not a lot of money to be made in bonds. And again, we do keep a look at the futures market so that we have a heads up in terms of having to make any kind of emergency actions on our SPY position. Meanwhile, emerging markets are getting hammered, and we'll see how this all plays out. Here's a look at the option market today in terms of expectations by Wall Street. In terms of trying to predict upside, the call option data is interesting. In terms of trying to predict where you can safely protect your capital, I like to look at the open interest, which is this OI column, on the put options. So a covered call where we're selling a call option means we'll sell our shares at a certain price, which might create a ceiling in terms of how high the SPY might trade to. And on the open interest on the put option side, it's the opposite. This is a floor. This is where big investors are willing to buy the SPY share. So we can see there's a tremendous amount of option writing at that 280 level expiring tomorrow. And we're currently sitting pretty on the 277 covered call. So there's very little chance that will turn into a loss, and it has that baked into the cake $1.25 profit per share on that. So we did very well on yesterday's trade as long as things continue. Okay, also 3 days to expiration, an even larger open interest sitting at that 280. So that's 280,000 contracts. Multiply that by 100, and that's how many shares of SPY will have to be purchased if we get to that level. So that's a very strong floor. And again, we're $3 below that. So we're sitting pretty on our most recent trade. And you can see there's a lot less open interest and volume once you go 10 days out. So the Wall Street option market on the SPY has been very good at predicting short-term moves in the SPY and the total market. All right, now I'll switch over to some of the updates we threw in our Diamond membership in terms of screenshots. Now, I also do post good videos to watch throughout the day. So if you want to see what we're studying, who we're listening to, which YouTube channels we're subscribed to, which articles we're reading, all of that data is published intraday into our Telegram groups. So make sure you do download Telegram and join the group chats that you're able to join based on your membership level. Just a quick summary of what we posted in here. Good interview with Kyle Bass. He's been hating on China for decades and finally getting his time on the spotlight here. So he talks about how China has been stealing our intellectual property and supporting the president. Also talking about how for once we actually have the Democrats and Republicans on the same side. So there's a lot of support for Trump for this trade war. And in this interview, they discussed the tariffs that were used during the period near the Great Depression, and warning that we are making steps in a similar direction on that. In the interview with Williams, he's talking about how strong the economy is and what they would need to see to either raise or lower rates. And they're sticking to their storyline that there's no change ahead for the foreseeable future. So those were the core interviews that we pulled out today. And that is a good overview of what's going on in our portfolios. I will take a quick look at the whale portfolio. We're expecting a good rush into the TLT. Now, there's a threat that the Chinese may dump their $1 trillion of treasuries. But the problem for the Chinese is that they have to buy everything, namely oil. They're the world's biggest importer of oil. they have to do it with dollars, so it'd be a very nuclear option for them to try to start liquidating their treasuries into the market, and is probably the biggest risk. But right now, the US Treasury is sitting pretty. It has the highest yield of all its peers. The dollar's the strongest. Our rates are the highest, and so it seems like a pretty safe trade right now at the moment. Now, long term, that's not really our look on the market. Right now, we think there's a good window to play the TLT, do the covered call. We're looking at where the open interest sits. It's very boring. It so far has returned 6.7% doing this during the same period as the other portfolios. But there will be a time where if this does escalate, I believe that we can see stocks crash. That would push the TLT potentially even higher as a safety trade. But as corporations would start to show declining profits, then they're going to realize these bonds are underpriced, and that's when we might rotate into the TBT. Now, on the other side of the coin, if everything's gravy, trade war is resolved, then we're going to be looking at potentially a short-term flip from the TLT into these core risk assets, which would be a portfolio holding Microsoft, Apple, Amazon, Google, Facebook, Bank of America, Wells Fargo. So we're not to the point where we would take that risk in this portfolio yet. So right now it's 100% on the TLT, and it's sitting on the 126.50 covered call. Okay, Jerry says last post in the Jerry, there's going to be a new link in every update to these current Telegram group chats, so keep a lookout for that and join them, and then you'll start getting all my intraday posts. So I just have optimized all those chats today and yesterday so that we can start linking to it from now on. So just look at the link of that. All right, guys, we're ready for some questions. If anybody wants to be unmuted, let me know. We have 20 people live right now. Let's see, Barry has his hand raised. Do you want, if you would like your audio unmuted, let me know, because some people do not. And if you prefer, you can always post your questions directly in the chat box. Let's see, I'm gonna unmute. Jerry, how's it going? You're unmuted so far, the only one.
Yeah, buddy, I want to know why you switched from the TBT to the TLT.
So we didn't. So in the basic product, we were hedging the SPY from rising rates with the TBT. And once it became clear that the trade war was going to escalate, we sold the TBT and we bought the TECS and the FAS. Once we saw a pop in that and a further escalation, we actually got rid of that and moved over to the long put option on the SPY.
So did the theory, said the basic thought of the TBT and what your thoughts about it just have changed? And
so yeah, so you could look at our equity trades right here in the basic product. So you gotta think about how they're working together. So the basic product is long the SPY, and its biggest risk really before the trade war escalated was that the Fed would raise rates. And if the Fed raised rates, that will make it much harder for speculation to flow into equities. So that was a logical hedge at that time. But then once we got a hint that the trade war was going to break down, that reduced the risk of rising rates and puts us in a situation where equities should be sold off because of a potential slowdown in global trade, and that would create a rush into safety. So it would make no sense to hold the TBT. So we put this all together by the 6th of May and rotated that same day into the inverse stocks, FAS and TEX. And now these dates I do need to update. We didn't sell this on the 6th. I'll go fix that. We sold it for a small profit. So we bought FAS at 803, sold it for 864, and we bought TEX for 322 and sold it for 1484. And those are actually up much more now. But when we sold those for a profit, we replaced it with a more leveraged hedge. So that's the whole idea, is we want to have protection against our bigger positions. And so we got to think about where is the big risk sitting in the market against our core position. So for the basic product, the core risk is either corporations' profits slowing down, which was not happening this year, or the Fed raising rates. And so because Q1 came in hot, 3.2 GDP, at that time, my biggest fear for the basic program was rising rates, which is what the TBT generates a profit from. But the second we saw the trade war was escalating and not actually a deal, that's when we realized it's time to sell that TBT and to find a different way to protect against an equity decline. So that's how that product has played its safety. The high yield portfolio has simply done it with the covered call and has not purchased any hedges outside of the in the money covered call, and likely will buy a put option on the SPY in a week or two. And I think we're going to have a week or two of peacefulness and be able to get a good 1% hedge on top of that for this portfolio. This portfolio only trades on Tuesdays, so it has to be more defensive in nature. And so it's taking less risk in the covered calls compared to the SPY. Now, this is a new product that you haven't seen, and it's replacing our emerging market product. There's little demand for that. Nobody wants to support China, which is what the EEM does. And so that's why we have added this one. And also, we've had some clients coming in who are managing multi-million-dollar portfolios. So the diamond product really isn't ideal for that. And that's why we've introduced the new whale program. Okay, I got a new question. What are you expecting to do with the 277 SPY tomorrow? Well, same thing we always do, Fred. We're going to buy to close and sell to open. Now, what strike will we pick for tomorrow's trade? We'll have to see. But most likely $1 or $2 below the current trading price. So we're going to remain in a position where we have protection to the downside. So let's look at that. Let's pull that up. And I'll also pull up that trade so that we can review it. Okay, so here was the most recent trade. So let's just look at the economics of this trade so everybody has a clear idea of how this works. And this is a good lesson on the safe way to predict a flat or down move in the market. And in a way where if we're wrong, the market goes higher, we actually still make money. Okay, Jerry, I'll look at your sheet, but I'm not going to be able to custom program your spreadsheet every week. So I think that probably the best bet for you is to issue a new spreadsheet and follow the program, because you're trading the VIX in a way where that should be your hedge and things of that nature. So it's but I will take a look at it. So let me just answer Fred's question first. Okay, so yesterday, this was our trade alert, 5:13. You can see it up top. Right here in this corner is the last trading price. So this is what's important to look at. So you can see the SPY was trading at 281.69. And we agreed to sell our shares for 277. And you can do the math in your head. That's a loss. We're agreeing to a $4.69 loss on our underlying asset. Why would we do that? Well, that's because, and I would say a relatively smarter than average stock speculator was willing to pay $562 or $5.62 per share for the right to borrow our equity for about 48 hours. So if you do the math, we're collecting 562, but if we are assigned and they exercise their right to this contract, we have to give back about $4.69. So that is a baked into the cake profit, which we have summarized up here, which I'll go up. So you can see we're collecting 462 on the credit, but we're taking a 469 loss on the SPY, which gives us a 93-cent share profit. So if the market goes up much higher and Fred is assigned, he has $93 profit baked into the cake. Now let's see what happens if we were to cover it right now. Let's see how that return looks. Okay, so here we have pulled it up. So let's look at what's happened on both sides of the trade. So first of all, we can see that to buy to close the covered call, we would have to realize a loss. We collected 562 at the time of writing this, and to close this out, we would have to pay back $8.12. So that is about a $3.50 loss. But what happened on the other part of the trade? Well, look at what happened. The SPY traded from 281.69 and is currently trading at 285. So we're sitting on a profit of 430 on the underlying asset. So we're sitting pretty. We have the profit baked into the trade. And what's going to happen between now and tomorrow is this call option is going to lose more and more of its time premium. So we're in a situation where we absolutely cannot lose if the market goes higher when we write this trade. But let's say there is a fiery Trump tweet tonight, and he says he's going to add that $300 billion of tariffs on all additional imports. Well, now you're going to be glad you're sitting on that 277 strike. So tomorrow's action will be to, right at noon Eastern, we're going to buy to close the 277. Then we're going to flip it to sell to open and go to May 17th. Now the strike will be different. We'll be making that decision at the time with the best data we can. Most likely it'll be something like this, $1 or $2 below the current trading price, and it puts us in a nice situation. Let's look at this trade right now. we can agree to take a 96-cent loss on the underlying asset and get paid $2.66. So we can make around $1.50 a contract if the stock were to go higher between now and tomorrow, plus have $2.66 of protection. So that's the power of the covered call that's in the money. It sets you up to do well if the market goes higher, to do well if the market goes flat, and as long as the market doesn't go below that strike price we've written it at, we cannot lose a penny. And again, we're not completely concerned with what the SPY is trading at. We're looking at this as if it were a house that we're going to rent out for the rest of our life for income and then be able to pass on to our children. So what would you rather have than the SPY? It represents America's top 500 corporations. And so this is not only a strategy you can do for the rest of your life, this is a strategy that your children can do for the rest of their lives. And when it's only $100 3 times a week, 52 weeks a year, maybe that's only $15,000 a year. But what happens when you have 1,000 shares of the SPY? Now you're looking at $150,000 a year of income. What happens when you get to 10,000 shares as your family collects and saves its capital? You can see how this really adds up and why it makes sense, especially when we're entering probably a long Cold War with China. They're not likely to just, the way they worded it is that they're not going to drink the poisonous fruit willingly. And that's really what we're asking them to do, to stop stealing technology, rip it off, and sell it to their $1.2 billion, 1.2 billion people that live in China. So it's going to be an interesting ride. And for us, the higher this goes, the higher the VIX travels, the more money we make renting out our shares. So there can be small times where we get caught off guard and the SPY drops below our strike. But that's only happened, I believe, once this year. And so for us, if we lose somewhere around 0.5%, that is a rare situation. Now, we're not going to capture all the moves of a bull market with this strategy, but we're definitely going to insulate ourselves against downturns. And so that's what makes this such a powerful strategy. And because we can follow the price of the SPY 3 times a week guaranteed, Monday, Wednesday, Friday, plus anytime the covered call drops in value, that means we have a profit we can realize. We can simply take the profit on a Tuesday, Thursday, and then write a new covered call and double our profits. So we'll get 2 paydays. And that's been happening a few times. We've had a few double payday weeks where we have done an emergency alert on Tuesday or Thursday right before a webinar and actually covered the position earlier and moved the strike lower. Barry, I see you have your hand raised, but when I try to unmute you, it says you're self-muted. So any other questions out there? Sure, Fred. Yeah, my pleasure. I saw you left, but you came back. That's good. So yeah, I think, it's hard to predict what will happen day to day. So that's why I'm watching the Trump tweet feed constantly. But I believe the big spike in volatility should subside for a few weeks until it's clear that the Chinese are not going to just bend over and take it. So I think that there's more volatility to come, and I expect to be doing a lot of in-the-money covered calls. And I'm also preparing to increase our hedges to protect to the downside. So very rarely do I want to put on a trade that can just evaporate your profits. And so for anybody who's done it, here's one of the fastest ways to lose money in history. Buy to open a call option on the VIX. There is more money that bets on this not happening, then you can imagine trillions of dollars rely on the VIX staying low, and when it does spike, that it will be shorted back down to earth. And so this is a trade I do not like to take. And this is one way a lot of people like to bet on a volatility spike. Very hard to pull off. Gary just came in late. Don't worry, Gary, we'll send out a replay. Yeah, you're about an hour late. We covered our 3 portfolios. So there's a lot of great content today. And we did review all of our trade alerts for the past week, so you can see exactly how this played out. So here's a trade I hate to do that can give us extra exposure to a volatility spike. So this could be a potential trade that we might add. If we do add it, we have to have a lot of reason to believe there is a volatility spike ahead. So this is one option. And then the only other really great option for protecting ourselves. But the thing is, if we buy a call option on the VIX, every second we're wrong, that loses value quickly. And so the covered call strategy may make a lot less profit, but we don't lose if we're wrong. If we start buying call options on the VIX, every day we're wrong, we're losing capital quickly. And so the only other way that we might consider protecting it, and the current trade we do have open for the basic membership, is this well-chosen put option. So this represents 1% of the portfolio. So you can see when I get pretty much everything lining up possible to dictate a potential stock market crash, this is the level of risk we're recommending, a 1% hedge. Okay, Thomas has a question. Okay, so right now our recommendation is this on the basic product is buy the SPY, but only if you follow the covered call, because the covered call protects your ass with a risk-free scenario. If the market goes higher, we make the guaranteed profit. Market goes flat, we make the guaranteed profit plus a little bit of time premium. And if the market goes down, then we make money in 3 ways. We have the guaranteed profit plus the intrinsic value of the call option losing value plus the time premium eroding. So it puts us in a very nice situation to be able to consistently protect capital, generate profit. We sold the TBT, Thomas. I'll review that why. We sold the inverse hedges. The inverse hedges are somewhat like a machine gun. You can buy and hold it and just fire away and not really worry about it too much. Whereas this trade is more like a sniper shot. And so if we're wrong and trade war is resolved, everything's, or even just delayed, this one will lose 1% our portfolio. We'll probably get out of it before we lost half. But if I were to go put on a large position in either TEX or FAS or a call option, those are going to lose value very, very fast. So we went up to a 5% hedge. So let's just review what we were doing in the mindset. Earlier in the year, the Fed lowered rates and said they're going to stick to that for a considerable amount of time. Stock market went very bullish, and so we've been trading that with the SPY. And so what's the biggest risk if corporations are having great profits, which they were? If the GDP of US is at 3.2 on the weakest quarter, great news. Everything was lining up for us. The biggest risk leading into the year was that the Fed would raise rates, and that would be negative for the stock market. So it made sense to hedge our long equity position with the TBT. But things changed once we realized that the trade war was escalating. Now we know that money is going to go into safe haven assets. So the TBT no longer made sense. That's when we bought the inverse ETFs. And then things escalated even further. China is now going to retaliate. Well, that's when we went from the machine gun to protect our capital to the sniper shot. And that's where we have this 1% position that can make a very big return if we get towards this level. So if things escalate, if there's no brinkmanship, I suspect that this 1% position could add around 3 to 4% total profit to our portfolio, which is about as much as we've made carefully doing these covered calls over the last 6 months. So it's a very powerful trade where we have the fundamental reason to be short the market with this, but if we're wrong, we're going to lose very little. So yeah, in our portfolio right now, there's just two things. You have the SPY with the covered call to protect short-term moves. And then if we get a precipitous, just complete drop in the market, this is where this one will pay off. In the diamond program, we don't have that trade. We just have the protection with the covered call. And in our whale program, we're sitting on the safest asset in the world, the TLT. So until the stock market has crashed, I don't see any problems for the TLT. So this is an easy one to sit on during times of uncertainty and risk. And that's why the TLT has been doing so well for us. And now this product is geared towards very, very large portfolios where not necessarily worried about hitting a big return, you're more worried about not losing capital. Gary says, I'm pretty new. Can you do a quick overview of all of it? Sure. Yeah, so there's really just a few things you need to know, Gary. First of all, the first move that we're recommending to everyone is, hey, you've probably got a random selection of stocks that carry a great deal of risk individually, and you're better off owning the SPY. So the first big move for most people, especially when we're going into a potential Cold War with China that may not last months, this could last decades. You don't want to own a bunch of risky stocks. You just don't. Now, the SPY has some big advantages. Not only does it represent 500 companies and give you a lot of diversity, it has the most demand in the world of any security. So you know there's a lot of people who will buy the SPY, trade $16 billion a day. Its fund is twice the size of the largest hedge fund in the world. So Ray Dalio's fund has $122 billion. The SPY has $240 billion. And to make things even better, it has an option market with expirations on Monday, Wednesday, Friday, which means you can sell a covered call to stock speculators, which is very, do you know how to write a covered call, Gary? No, okay, so let me show you how easy this is. Step one, you have to own 100 shares of the SPY. Now that costs about $28,000, and that's why you have this advantage. Not everybody can afford to do this. Step two, you can sell to open and you can see all these dates, May 15th, May 17th, May 20th. So from today till tomorrow, you could sell the right to a stock speculator to borrow your shares. And with the SPY trading at 284, let's see what we could get paid right this second. So this is a strike that that's closest to the current trading price. So with this trade, I'm agreeing to sell my shares to this person for $284.50. And for that right, he is willing to pay me $119. So he's betting that the SPY will go up between now and tomorrow by at least $1.18, because that's how much he's losing up front. So if he's right, the SPY jumps to, let's just say, $2 higher, he's going to double his money. He will have turned his $119 into $240, killer 100% return. But if he's wrong, we keep our shares and we keep his money. And so that's the name of this game, is that we can get protection on our assets and basically be the bank. Instead of lending out dollars, we're lending out shares. Now, what happens if you collect $100 3 times a week, 52 weeks a year? Well, that's 156 events. That's $15,600 of income without the SPY going anywhere. SPY could trade flat. If you collect $100 3 times a week, that adds up. So that's what this product's all about. Now, I think if you do watch some of the webinar replays and tutorial videos that we have, Gary, how often do you lose? So we've lost capital, and we're talking like 30 bucks. We've lost 30 bucks about 3 times in the last 6 months. So this is a very high probability system. So while we're trying to make about 0.3% on capital, 30 basis points, that's 1/3 of 1%. That's a very greedy trade for us. And so, yeah, we almost never lose. And that's why our product's popular with wealthy people, Gary. This is not attractive to someone who wants to get rich quick. You know, the guy who wants to get rich quick wants to buy that call option for 120 bucks and hope we get a big rally between today and tomorrow. The smart people do the opposite. They say, okay, I'll hold on to the world's best asset, which is the SPY, and I'm happy to do that for the next 10, 20, 30 years, and then I'll pass it on to my kids. And in the meanwhile, I will rent out my shares to stock speculators. And so put you in a situation where they are paying you to insure your assets to a certain level and generating profit at the same time. So it adds up. It really adds up. What's the minimum? Yeah, you have to be able to buy 100 shares of the SPY to play. So it's kind of like buying a house. You have to buy the house, otherwise you can't rent out the house. It's just that simple. And there's no other security in the world that has this rental set up in the option market 3 times a week. So not only is the SPY ETF the highest traded security in the world with the most capital behind it, it also has the most active option market, which is where we generate the consistency in return. So you will have to buy 100 shares of the SPY to be able to follow this program. Now, most brokers will give you one-to-one leverage. So, you know, you could do $15,000 and still buy 100 shares, but you'll be paying about 5% a year interest on the borrowed money at most brokers, and that just depends. But yeah, it's a very small return that we do over and over and over and over 3 times a week, 52 weeks a year. And Gary, if you want, I can unmute you if you want to chat. Do you have your audio, Gary? Oh, no worries. Well, go ahead and fire away. No bad questions. If you have a question, I'm sure 10 other people on the webinar have the same one, and we're just too shy to ask. Do you currently own stocks, Gary? And if so, what's your largest position? Which security? Okay, not currently, but have lost a lot of money in the past. And that's a story that is all too common. And so my kind of storyline for why we created this product is I had a company that grew very rapidly, where my job was not to design the trading strategies necessarily. I did have a few during that period. But primarily my job was to go recruit the most qualified, best pedigree, most famous traders you could find. We did a great job of finding those folks and bringing their products to the market. And what I found was a very common problem happening over and over and over again. All of them thought to have any value to the market, they had to outperform the S&P 500. And what a joke. 10 years later, the SPY ETF is single-handedly not just beating out all these silly advisories out there that are advertised. the SPY ETF is putting out of business a record amount of hedge funds. More hedge funds had to liquidate in 2018 than ever in history. And the reason why is because the smartest minds in the world cannot, for the life of them, outperform the S&P 500. They just can't. They've proven that they just cannot outperform the S&P 500. And so it's no wonder that most of these little advisories out there that you've probably seen touted, from Agora to all sorts of different products out there, that's their goal. They think they need to outperform the SPY. But the chances of them doing that for a considerable amount of time are very low. And so right off the bat, they're taking outlandish bets to predict that something in the future will happen. And most of the time they're wrong. It just doesn't pan out and people lose a lot of money. So how about a product where you can jump into it for free, no credit card required, try the trade, see it works. That's what this product is. So we're not just trying to be the SPY, we're actually trying to take some of the volatility out of the SPY and take advantage of the options market. So you're holding on to an asset that in itself speaks wonders. It outperforms everybody. Even the world's biggest hedge fund, Ray Dalio, doesn't try to compete with the returns of the SPY. In fact, his bigger claim to fame is just less volatility. And so that's what this product's trying to do. We're taking the best asset in the world, the SPY ETF, and we're teaching you how to take some of the sting out of it going into retirement. How can we protect capital and turn your portfolio, instead of a speculative guess that the markets will go up forever, what if we turn it more into a business where you can basically turn it into a rental property? You own 100 shares of the SPY, you can now rent this out 3 times a week for the rest of your life. And we're not just showing you, the exact trade. We're showing you why we're doing the trade. We're teaching you how to fish. There's no magic to this strategy, Gary. This is a very simple strategy. It's easy to understand, and you can start following it tomorrow. There's no magic sauce. There's no big predictions. The thing that I do believe I bring value to the table is trying to spot out big risks before they happen. What retirement income can you generate? So in our basic program, our goal is to generate a safe 1% a month. And if we're doing better than expected, up to 2%. And so our goal is to have extremely low drawdown and try to pull around 1 to 2% a month. And that's in our basic program, trading the SPY. Now, if you do have more capital, this product is our diamond program. It's very similar. It only trades on Tuesdays. It's going for closer to 2 to 3% return, but it requires more capital. So if you look at the SPY ETF, what does it actually buy for you? It's just a fund that redirects your capital automatically. Well, this is what it buys for you right here. These are the top positions. And so if you do buy the individual securities, now you're not letting the ETF steal all the profits out of the option market, and you can get a better yield. So when you do buy the individual companies, it costs around $150K to build this portfolio, and we're getting twice the return to date. Also with 1/3 of the work. So there's some big advantages. Also think about it. Who has the biggest profits? These 8 companies do. Who has the most corporate buybacks? These 8 companies do. Who has the best credit rating to sell bonds? These companies do. Who's going to get the most money automatically from the ETF world? These 8 companies. So you can understand why these stocks not only have a better covered call yield, they've outperformed the S&P 500 because they are the leaders of the S&P 500. Julio says, can I use a self-directed Roth IRA? Yeah. Oh, yeah. And now you don't have to pay the 35% capital gain on this income we're piling in every, I mean, of course, you're still going to have to pay your taxes when you do withdraw, but you can let your profits compound in an IRA and not have to pay taxes on every single profitable event, which is at least 3 times a week, sometimes 5 times a week, we're realizing profits from the covered call. These are great questions, guys. Any others out there? Tell me your biggest concern. A market crash. Sure. So definitely, and that's the thing I primarily focus on. If market goes up, we have nothing to worry about. We make money, we sell the covered call, we actually get what I call the double payday because the asset goes up in value, plus we get to keep most of the covered call income. So certainly a market crash is the biggest risk for everybody. And of course, if the S&P 500 crashes, everything else is crashing alongside it. So got to ask yourself, can you find a better strategy to protect and profit from a downturn? I haven't seen one, and I've been selling the best minds products for the last 10 years. They all do it with risky trades that if they're wrong, you lose 100% of the cash risk to do that. Okay, Gary. Okay, Gary's looking for the income. Well, Gary, how much capital do you have to put to work? That's really going to decide where you should be. If you have less than 150K, you're stuck in the basic program. If you have over 150K, the diamond program, and if you're over $1 million, then you should play it smart. You're set for the rest of your life. For heaven's sakes, don't take stupid risks. The whale program trades US bonds through the TLT ETF, so we can still take advantage of the covered calls and get much better yield than you would from buying the outright bonds. Thomas says, if you could pick one stock, I would pick the SPY. Julio says the minimum amount to try. So you have to buy 100 shares of the SPY. So that's the minimum investment, which is about 28,000. But if your broker will give you one-to-one leverage, almost all of them will, especially to buy things like the SPY, which is the most liquid and high demand stock. You can usually do it with 15. So yeah, just to break it down, for very rich investors, the whale club is by far the best strategy. We're not going to try to go for a big return, somewhere around 10 to 20% a year, and playing it extremely safe. If we're trying to trade around 150 to $1 million, the diamond portfolio makes a lot of sense. It's the same thing as the SPY, but better. We've taken what the SPY buys for lazy people, and we've just taken an extra few minutes to buy the actual securities themselves. So if you have 150K, this product makes a lot more sense because you get a better yield. It's the same thing. It's really the same thing as a SPY. It's just the core positions pulled out. We've removed the cushion. We've got rid of the in-between people, and now we can get a better payout on our covered call. Now, if you're just buying and holding, I'd argue maybe the SPY is better because it'll automatically reallocate your capital. You have more diversity, but we're not trying to buy and hold. In fact, if you think the stock market's going to go up another 10 or 20% this year, you're probably crazy. But we're going to quietly make that just by writing covered calls. Okay, the price of the services, the basic program retails at $1,000 a year. And if you look at every email, there's a phone number to your support agent. That'll be your person who'll help you throughout your entire time as being a member. So they have a little discount over the phone. The Diamond program retails at $5,000 a year, and they do have some small discounts that can offer you on the phone. And the Whale program retails at $10,000 a year. And so for most people, they want to get started with the basic product. We do discount any investment you've made on the basic product towards a more expensive program. And we give you a 30-day free trial to the whole combined set. So when you do upgrade your free trial to the basic, you're also going to get 30 days access to the Diamond and the Whale Club. And that way, at the end of 30 days, you can get some rapport with our team, with your coach. You can see what makes sense. you're going to realize, wow, this guy is doing it a lot smarter and a lot safer than I was. And you can see where you fit into the picture. So most people like to start out small, trade the SPY, and then they're like, all right, this really works. There's no magic. It's very transparent. It's very easy to follow. And I'm scared. You know, we're going into war with China. How else am I going to generate income? You know, you tell me, what else are you going to do? Okay, so Fred says he's planned on making $50 3 times a week for about 25% a year on 30K, or 50% a year if I use margin. Is this realistic? Yeah, Fred, that's, you know, and I'll be completely honest. Our goal in the basic program is to safely generate 1% a month. And I like to under promise and over deliver. So I will try to get us 2% safely, but my real goal is a very safe 1%. And so yeah, you've seen we've actually been doing way better than 1% a month because the volatility is higher. And so you know, the markets, we're going to take what the market gives us and we're going to play it safe. That's what I can really promise to you. Rather than worry about trying to guarantee 50 bucks 3 times a week, I'm going to make sure you don't lose your ass and lose your money. So that's more important to me. And you know, it just takes a week like last week and early this week for everyone to realize, wow, market crashes, I'm screwed. But if I'm following this guy, he's made more money than normal. You know, we've been making 90 to 125 bucks a contract during this very rough time, when most people lost 5% of their total wealth in a week. They lost 2.5% intraday on Monday alone. So, yeah, certainly we want to make 50 bucks or more 3 times a week. But sometimes we got to play it safe. Maybe we'll go for 25 bucks. And so the volatility level dramatically changes where we can make our return and what we have to do to get that return. Now, I'll tell you what, Fred, we get a stock market crash, volatility is going to spike. That'd be the best thing ever. We're going to outperform 50 bucks 3 times a week. Opposite happens, volatility drops, everything's easy, stocks are heading up. That's going to be a more difficult time for us because now we know stocks are going to get into really high valuations. Now the Fed's going to start creating a worry that they're going to raise rates. So yeah, we're just going to play it as safe as possible and generate consistent returns. ABBICCC says, is there a website to get more information? At the bottom of every email is a summary of our products and the pricing to order online. But if you call your coach, you can save. So you might as well call your coach. He's there to help you during your entire subscription and does have some discounts over the phone. So just look at your email from today and yesterday. The top is a phone number to your coach, and below at the footer is a description of the products outside of what we've just covered here. Fred says, I like your approach. Thank you. Well, hey, Fred, thank you. And I hope you're enjoying the service so far. All right, last chance. Any more questions? And he says, I am. Well, that's great, Fred. We love to hear people are doing well. And, you know, this last week was a really good eye-opener for people. I like to tell our coaching staff, hey, you don't go to the doctor when you feel good. Well, everybody felt great all year, and now they all caught the flu. So guess what? Everybody's coming in to get their antibiotics and start feeling better here. So the good news is you can convert your portfolio from a risky one that's buy and hold to a safe one that has the world's most important security and add protection in less than 5 minutes. All you have to do is liquidate whatever stocks you're holding, buy the SPY, write the covered call. You're now protected, you have a better security, and you can rent it out for the rest of your life. So as far as I know, there's no other products out there that, number one, don't require a credit card up front to see that it's a real deal, and then two, are so transparent. You get to see what we're doing. You get the same prices, you get it instantly at the same time. It's at noon Eastern, Monday, Wednesday, Friday. Predictable, liquid, safe. All right, last chance for question. All right, gentlemen. Well, another great webinar. Thank you, everyone, for participating. We got a trade alert in the basic program tomorrow. Thursday, I will start covering cryptocurrencies. We actually have a huge return in our cryptocurrency portfolio. That's a small position. We're recommending at most 5% of your portfolio hold cryptocurrencies. We've been recommending that all year. That portfolio is more than doubled, so it's about time to take profits off the table and get our allocation way down. So that that portfolio is now about double allocated, so it will be time to take some profits and look at some ways to protect those profits on the Bitcoin run up. So thanks again, everyone, for your time. Look for a new trade alert tomorrow. Thursday, we will cover the whale program plus cryptocurrencies. And then Friday, another basic trade alert. So thanks again, and looking forward to more content tomorrow.